So welcome to our panel. Securitize this. We've seen a lot of securitization over the years, haven't we? And now we're going to get a look at a very specific, but potentially very dynamic, and maybe even some would say game-changing area of securitization as the world needs to build more subways, as we just saw Jakarta building its first one, wanting it done by next year. And we have three very special guests who bring a different perspective and a different kind of background, each one of them, to the same field, which, according to them, they all see it as dynamic, growing, full of potential. And so we're going to start, because I think if you're not in this industry, if you're not in this field, there's a lot of things to understand just to kind of set the stage. So each one of them is going to give us just a brief synopsis of who they are, what they do, what part of this industry belongs to them. And Alain, let's start with you.
Thank you very much, Kathleen. Good afternoon to everyone. So I am Alain Gallois, working for Natixis. I'm the CEO of Asia Pacific. Natixis is a very specialized bank on several expertise. Among those, you have infrastructure project financing on one side and securitization on the other side. And on both, we aim to be, for our clients, the go-to bank. So the topics of today is exactly at the heart of what we want to develop at Natixis.
All right. Leslie, you're next.
Thank you very much. My name is Leslie Maasdorp, and I'm CFO of the New Development Bank, also known as the BRICS Bank. The bank was created by Brazil, Russia, India, China, and South Africa. And it's very much fashioned to become an emerging markets-focused multilateral development bank. So the way to understand us is to really position us within that universe of institutions like the World Bank, Asia Development Bank, Asia Infrastructure Investment Bank, Africa Development Bank, and so on. The bank is headquartered in Shanghai. The bank was started with $50 billion of subscribed capital. $10 billion of that is equity or paid-in capital from the 5 countries, and $40 billion is a form of a guarantee called callable capital. And typically what we do, we finance projects of the kind that you've just seen there. We, for example, in the process now of funding a metro exactly like the one we showed in Indonesia, in Jakarta. We're funding a similar one in Mumbai. It will be the first one, again, in a city of 18 million people. Because we were only started recently, we are looking at what are the new and more innovative ways in which the bank can mobilize more capital into the space of infrastructure finance. Traditionally, as you know, banks have, and also because of Basel and other requirements, they have been restrained from investing in these long-term assets. So what we're talking about today is using securitization as one instrument to potentially crowd in a lot more funding.
I like that, crowd in funding. I bet you're waiting, Paco, when you're waiting for more people to crowd into what you do, correct?
Yeah. Okay, my name is Edwin Syahruzad. I represent PT Sarana Multi Infrastruktur, which is a government-sponsored infrastructure finance company. Our mandate is to provide finance to infrastructure projects, in particular long-term finance. So we have, at the moment, 5 billion commitment, lending and equity investment to infrastructure projects across Indonesia. And the relation to the securitization, I think it's part of our company agenda, because we cannot grow our asset without free up our capital. So there will be time for us to securitize our illiquid asset and have a broader access to investors locally in Indonesia.
So let's, again, kind of building from the ground up. I can think of infrastructure, I can think of bridges and subways and tunnels, and every country, in one way or another, it seems in the world, is doing more with infrastructure, whether it's Indonesia, United States talks about it, doesn't do much. But anyway, securitization when it comes to infrastructure spending, Alain, what is unique about it? What is important about it? How is it changing?
Well, first of all, if I may, Kathleen, we need to define a little bit what securitization means. For the common understanding, securitization is a kind of structure that we have now, very developed in America, quite well developed in Europe, growing in Asia, where you tranche transactions thanks to granularity. Actually, if you look at the real definition, securitization is more transforming an asset into a security, okay? And this is actually what has been done, and this is the growth of the market. I would say that since 2008, so since the global financial crisis, the market evolved dramatically and start with a kind of disintermediation through securitization. And the first tool was the bond market. It was well developed in Canada, quite well developed in Europe, and growing a bit in Asia. The second tool was to try to educate what could be the other, in terms of diversification, investors. Because as mentioned by Leslie, the bank, the traditional commercial private banks, don't have enough capital to allocate to those kind of assets, which are very long-term assets. Mm-hmm. So finding new way of financing those assets with the multilateral banks, with the sovereign-owned banks as well, and new kind of investors, such as lifers and pension funds, are key fundamentals to make sure that we will be able to absorb, in terms of financing, all the projects that you have seen on the screen.
So let's jump to you, Edwin, from the point that Alain just made in terms of this changing investment field and banks who did one thing, banks that might want to do something else, and even other kinds of investors, you said, bringing in pension funds, life insurance, and more. What are you seeing? What have you found in your work?
I think it's a matter of the selection of the underlying asset class that will be appropriate for securitization. Yeah? Because here in Indonesia, if you're talking about Indonesia, in the past, before Asian crisis, there was a precedent for Indonesia securitization based upon the consumer finance receivable. But to me, infrastructure asset class could be some potential because of this characteristic stability and cash flow. So securitization, future revenue of the infrastructure asset can be very potential for Indonesia to grow their securitization in the future. Last year, for instance, 2017, we witnessed 2 deals of securitization in local currency market, whereby one of them is the securitization of the IPPs.
The what?
IPPs, independent power producers. The future revenue of the contract with the PLN is securitized, and the bond, the securitized bond was rated AAA. And the other deals was securitization of the future revenue stream of one of the toll road concession owned by Jasa Marga. I think that one deal also was assigned AAA rated by local Pevindo. So I think in this particular sense, I think infrastructure asset class could be the potential target market for securitization in Indonesia.
So Leslie, do you want to bring in the new development bank and the role of what you, because everybody's trying to get something out of it, and of course everybody is sort of helped by infrastructure investment, but sitting between these two, what do you bring to the table now?
Let me just start by saying that multilateral development banks have existed for a very long time. They are very highly rated institutions from a credit rating, a credit quality perspective. They're typically AAA. In our case, we have a AA plus credit rating from S&P and from Fitch. But there's about 24 of these institutions that are AAA. These institutions have not effectively utilized or used that high rating in order to crowd in, to use that word again, to crowd in more private sector capital into infrastructure. Securitization offers one such possibility. What is happening right now is that the banks have gone back to the drawing boards to ask whether our existing products that we use, providing loans, providing equity, providing guarantees, whether that is sufficient to bring in more capital into infrastructure. And we have come to the conclusion that it's not. There's a major report that will be launched tomorrow by the Prime Minister, the Vice Prime Minister of Singapore, which came out of the G20 process, where they have assessed the business and operating model of multilateral banks, and they've come to the conclusion that these institutions ought to slightly change gear and move more towards not just becoming providers of capital, but to mobilize more capital. And securitization is one such instrument. And just recently, literally a matter of weeks ago, the Africa Development Bank closed such a, what they call it, synthetic securitization deal, where by selling off some of that risk to a New York-based hedge fund called Mariner Investment Group, they were able to create bigger capital headroom for themselves, meaning they have more lending capacity. They can do more projects like the one we've just seen. Ultimately, that's the objective.
Okay, as the person who's sitting, I'm thinking, okay, securitization. Didn't we hear this? Buy this, securitize that, 10 years ago, right? Now, I'm not saying that's what these guys are doing, but maybe that's one reason when people, you think, oh, we want to crowd it in, get people to get these securitized assets. You've got AAA ratings, right? Well, there's many questions that come to mind, but I want to start, we have a polling question we're going to put up, because I think again, to me this does seem very exciting. It all makes sense to me, but I think there's a question, if Mark's back there, that we can pull up. Okay, I'm trying to remember exactly what it is. Does the securitization of infrastructure assets need more regulation? Because as my panelist taught me, or made me think about, they don't really have a lot of regulation, right?
Yes.
And in effect, the credit rating agency is the regulator. That sounds great, market discipline, right? But, at least when it came to mortgage-backed securitized assets in the United States, that model did not really hold up. So I'd like you to each, again, from your own perspective, weigh in on this, because I just wonder, when you're trying to sell something, crowd in some capital, do you find, is everybody just realizing this is a totally different kind of project and it's backed by a big bridge or tunnel or something? Or are they kind of wondering just what they're getting into? Go ahead.
Well, actually, what you are referring to is effectively the story of the securitization. The problems we faced during the GFC was not securitization, was excess of the usage of the tool, was creating securitization of securitization, i.e. the market of the CDO square, right? So effectively, you're right. Afterwards, we try to redevelop this tool, which is a real tool of access to new kind of assets to a large spectrum of investors. And we redefine it through regulation, through strict criteria, in order to make a safe investment tool, which is, for me, the most important thing. Because thanks to securitization, you address your potential project to investors who can buy AAA tranches, more safe assets, or we can buy, as mentioned by Leslie, equity pieces. So you address a large number of potential buyers, which will be able to complete the huge supplies which is growing up in Asia and especially in Indonesia.
So Edwin, you're a public sector entity, so you represent my interests. So how do you answer that question?
I think we view securitization based upon the framework that is simple, transparent, and standardized. So everything has to be simple, transparent, and standardized. So the underlying has to be followed that framework, so that we can avoid, like you mentioned before, re-securitization, which is we don't know the exact underlying or the underlying credit risk of the underlying. So by make it simple, transparent, and standardized, so we can actually reduce the ultimate credit risk of the underlying that makes securitization basically is just transforming the illiquid asset into securitized instrument. And by securitization, it can reach the institutional investors to be participated in infrastructure space, rather than we commercial bank, the only players who participate in the infrastructure space, but we can reach the ultimate institutional investors as well.
Okay,
Yeah.
and before we let you weigh in, Leslie, wait, because first of all, I got to remind you, if you're a tweeter at Bloomberg Markets, go ahead, just tweet your hearts out, and remember, you can answer this poll question, okay? And so you can do it now, do it later, and we'll kind of have a vote if they're going to convince us. Well, I'm already convinced, but nevertheless, go ahead, Leslie.
I would like to just build on the point.
Oh, look, wait a second, wait. Oh yeah, I didn't even see. You can turn that. You can turn that around. You can tip the scale.
That could be two votes, right? That could be two votes, one each. I wanted to just build on the point around standardizing the products. It's changing now. So people are finally voting. There's more realism entering.
As soon as you speak, it's going up, you know, the regulation.
Okay.
I mean, I agree fully with the point that my colleague just made around standardization of the product. I think I can definitely foresee that going forward, certainly within multilateral development banks, there will be a sort of, we will all enter the securitization space, but not in a sort of haphazard way. There will be standardized products that will develop. Secondly, and very importantly, banks like ours have very conservative risk management policies, and the reason, and financial policies, the reason is that we are focused on preserving our high credit rating, because that's very essential for the business model. Having a high credit rating means that we are able to raise funds cheaper from the market, from the debt capital markets, and then on-lend those resources and have prices that we give to our borrowers that is very preferential. So we will do that with the credit rating agencies. They are, as you know, our de facto regulators. We do not really get out of bed in the morning unless we look at whatever we do, what implication might it have on our credit rating. So the securitization space as an instrument will be deployed in line with the acceptability and the comfort levels that credit rating agencies have. It is therefore not surprising that this transaction I just referred to with the Africa Development Bank concluded a securitization deal recently, was done. It took them a year to close that transaction, 1 year. And it's not a large transaction, I think it's $1 billion. But they did that with full sign-off from the rating agencies. So in short, what I'm saying, the regulation is an important dimension of making greater use of securitization.
So in terms of, you've mentioned tools, new tools, and so now let's say, okay, we accept that this is legit, this is going to work. There's all kinds of, it's a good investment. But I think what you've also talked about is it's going to be a better investment because of the way there's innovation to take the tools and make more. Take one tool and make it 5 tools, so that if I'm sitting in this audience and I'm thinking, well, I don't know if I want this, but if you said to me, oh, but I could sell you this. Yeah. What are the innovations? What are you seeing? What are you going to invest in, and what are you doing? Well, let's start with you, Alain, in terms of what do you think people need to know about?
I think in terms of innovation, well, the way we are currently looking at securitization, and especially on infrastructure, could it be the transaction mentioned, which was a synthetic transaction? Could it be this infra CLO, which is growing up, are very innovative transactions and are totally in line with the expectation of the market. Before, you had a big potential of supply, but not real demand, except coming from few limited banks, the development banks, and not enough non-bank financial investors. Now you have still the public bodies, the traditional banks, the development banks, and a growing part of private investors, which didn't exist before. We estimate that 58%, for example, in Indonesia, on the future project, will be financed through these private investors. If we want those investors, life insurance company, pension funds, to invest in such kind of asset, infrastructure asset, I mean, the best way to offer transparency, liquidity, and safety is securitization. So this is why I do believe that the potential of securitization due to the potential of the market is just massive.
Yeah. Just to build on that, if the multilateral banks, as I said earlier on, the operating model has pretty much stayed the same for decades. It is now changing. And it is changing because if you think about it just through basic financial lenses, to originate a loan, a long-term 15, 20-year loan, and to hold it on your books for that entire period does not quite make sense, because once the riskier part of the project, once you've built the power station, once the port is up and running, once the airport has been built, it generates stable, predictable cash flows for a very long time. At that stage, you can bring in other investors who like that risk-return profile after 4 or 5 years. So as a development bank, we could take the risk of the riskier parts, if you like, in the upfront construction stage of the project, for example, and then repackage these projects. So it's about recycling the risk capital and to not hold onto your balance sheet everything that you originate. So the model is no longer originate to hold, but originate to distribute. And as we've just heard from Alain, insurance companies and pension funds there's large pools of money there that is not productively utilized, meaning it is not invested in long-term productive assets. There's money lying idle in very low-yielding instruments when it could be deployed in emerging market infrastructure assets. And in the process, we're building these economies, creating jobs, building prosperity, and creating a better world.
And bouncing back, if I may,
No, please.
to what Leslie said, the job of the banks is much more to take care of this construction period. Could it be public banks?
Exactly.
Could it be private banks?
Exactly.
Then after it becomes to react, just like more an obligation, a bond, like anything else. That's why it's more adapted to life insurance company
Exactly.
or pension funds, which are looking for long-term assets. Infrastructure is long-term assets. And that fitting in terms of ALM, asset liability management, perfectly well to what they are looking for currently, diversification and yield.
I say you sound like you're in a sweet spot, Edwin.
Yeah, I think securitization, remember, securitization again is secondary finance. Primary finance can be done by us, yeah? And commercial bank, we take care of the credit risk during the construction, and once it become operation, yeah? I think it's good to invite or broaden our investors base so that investors like pension fund and insurance company can participate indirectly in the infrastructure asset class. Secondly, I think it's part of our strategy to free up our capital because if we stuck in the long-term infrastructure credit asset, so we need more. Even we are given a mandate to develop more infrastructure. So we try to find strategy to free up our capital so that the money can be utilized to other infrastructure project. So that's our company strategy. And lastly, I think the most important thing is that it adopt market discipline because we have to maintain our credit rating and we have to create product in such way it fulfill with the investors' credit appetite, which is some investment grade. So we have to push to originate the sound or credit asset in such way we can deliver or free up our capital in accordance and without jeopardizing our credit quality, corporate credit rating.
I just wanted to build on, and as you can see, we are very excited about the potential growth of the securitization market as an instrument to provide greater finance for infrastructure. But I think it's very important to point out that this is not a panacea. We cannot overnight see a sort of a wave of securitization, for example, happening in our industry, in the multilateral development banks, because it is just one instrument amongst an entire spectrum. For example, guarantees have also been underutilized, where you provide a guarantee, so the capital remains in the bank of the, let's say, of New Development Bank, but we provide a guarantee which enables that institution to go to other commercial banks and raise funding on the back of our very high AA+ credit rating. So syndications, guarantees, securitization, these are all instruments, but we shouldn't now leave the audience with the impression that there's a new panacea for solving the infrastructure gap, the financial infrastructure gap challenge that the world has been facing for many years.
In terms of developing this market, and you're talking about the various kinds of institutions, banks that might even take on a different kind of risk, hedge funds, other ones, what's the interplay with that and the fact that this is, it's like municipal finance, right? A bridge in Indonesia is different from a tunnel in Seattle. And I know, Edwin, you brought up a point about some of the legal aspects of this with a particular kind of financing in Indonesia. Tell us about that, what your concern is, and how it kind of fits into this bigger picture. To me, again, if I'm a hedge fund someplace looking at all the things I could invest in, what seems more problematic? What is generic enough or understandable enough? I say, yeah, for sure. I'd even give up a couple of points, give up a couple of basis points just to have that kind of understanding and maybe something that's a little more, I'm not plain vanilla, but maybe it's something that's a little more.
I think what you mean is the use of local SPV, because when you mean the securitization, it has to be through sale, it has to be transferred to a specific entity, which can be ring-fenced to any bankruptcy. So if you, according to the capital market regulation, the SPV that is eligible, yeah, to act as intermediary is KI/KEBA, and in fact, it hasn't been tested yet. Yeah. So that we don't have any data about the default history, recovery, as well as the timeliness, yeah, when it comes to bankruptcy and liquidation. So there's no data or precedence of the time to recovery of this particular SPV. So I think that one is the challenge, but we have to try, we have to begin. And so far in Indonesia case, there's no precedent. Even prior to Asia crisis, securitization of the consumer receivable has proven to be a very good asset class since it is ring-fenced to the originator.
In fact, didn't one of you mention to me when we had a conversation getting ready for this panel that other things that did suffer in recent crisis, these held up fairly well?
That usually infrastructure project, infrastructure loan are very well structured, quite robust structure. So they didn't suffer directly from the global financial crisis per se. When we have an issue, it's more linked to the merchant risk or the traffic risk linked to the project. But to come back to your question regarding what will be the extra match which the investors will be interested in, I mean hedge fund, but also I think life insurance company. The lifers for me will be the bulk of the real non-bank or non-bank investors to grow in that market. I think it's quite easy. Today, it's underweight, largely, because fixed income, equity, real estate are the bulk of what they are doing in terms of asset allocation. Today, it's underweight, okay? Today, we still need, at the bank, to educate those investors on the advantages, but also the potential weaknesses to invest on such kind of project. And the potential of that market, again, is just massive. Could it be in Asia, and especially in Indonesia, or could it be linked to the Grid and Belt initiative, Belt and Road initiative, sorry. So investors will be tempted because they will put at work people that will analyze a market which is a growing market, where in terms of strategic allocation, it makes a lot of sense in terms of diversification of assets, in terms of correlation or non-correlation between those different parts of their allocation.
I think more importantly, just to add what has mentioned by Alan, the government is very active in improving the ecosystem of the infrastructure business case by providing what you call it availability payment, viability gap funding, so that infrastructure project that are developed right now is built based upon business viability rather than, if you're talking 20 years ago, yeah, it was a public spending without having just business justification. So I'm very confident that this market discipline infrastructure development can be easily being securitization and can be prone to like what external circumstances or external shock, because the project robustness or the concession agreement, the solid concession agreement is behind the infrastructure asset class itself.
I was also just going to add, Kathleen, that the returns are, the commercial returns associated with these securitization instruments can be very, very attractive. Let's talk again about this Africa Development Bank deal. I don't know the exact numbers, but these are high double-digit type returns. So the bank, Africa Development Bank, is paying a fee to this institution, to Maasdorp Investment Group, for providing that insurance, because they're taking on some of the risk, if you're right, of those projects defaulting. So it is a very attractive instrument. That's why I'm very positive that its potential use will increase over time.
Well, high double digits with a AAA rating sounds attractive, but it almost sounds too good to be true. I mean, you're convincing me. I don't know what the poll says now, but I wonder if that's the case. When do we see the rush of investors in there, right? Because if you guys are out there, if you're doing this and your bank's doing it and you've got customers who are interested, at some point I would think people would say, well, look at that, right? And especially in a world, we know the Federal Reserve is raising interest rates, but it's going to be slow and gradual, and rates and yields are still so low, much below what they used to be. When is that arbitrage, when is that going to go away? Or what's the lesson? Go in, buy now, or is it just too hard to, unless you've got lots of money and a smart guy like Alain or Edwin or Leslie on your side to help you figure it out?
I think there are a number of constraints and potential obstacles. Firstly, the one that Edwin already mentioned, that there needs to be a standardization, and that it needs to be much more, reduce the complexity is always helpful, right? It needs to be simple, standardized, easy to understand for investors to get a handle, and that process is still underway. Because we cannot return to the period before the global financial crisis where securitization wave led to crazy structures. I mean, you just have to read any of the books on the financial crisis to know that common sense did not prevail with loans being structured with people from, they called them ninja loans at the time, no income, no job, but people got mortgages from banks, and these were then packaged and sold to investors. These are clearly very, very risky assets at the time, but they were given very high ratings by the credit rating agencies. So the first thing is just the complexity of the product. Secondly, it won't be easy to do these overnight. As I said, this one deal with Africa Development Bank took the better part of 12 months to conclude. So, there's that a component as well. Thirdly, banks like ours, for example, there's a cultural aspect to overcome, where people are used to doing things in a particular way. They used to have the traditional providing loans, vanilla loans, or providing vanilla guarantees. This requires a bit of innovation. You have to think out of the box. And so that's another hurdle, a potential hurdle to overcome. And then finally, transaction cost. There's transaction costs to conclude these deals. There's advisors who need to come in. It is not straightforward where tomorrow there can just be a wave of transactions coming into play. Those are some of what I think are some of the obstacles we need to overcome.
I think in Indonesia case, perhaps we have to be frank with you that if you are talking about infrastructure players, I think there are a domination from state OE. Pretty much most of the players are still in the under leverage, except for the toll road players like Jasa Marga or Waskita Karya. So I think the one that can be low-hanging fruit is the securitization of the concession assets under the toll road company. Yeah. Perhaps that may see which fit with they need to free up their capital because they are still assigned by the government, or they are still hungry with the new capital for developing a new toll road. Yeah, and so that one can be a good target itself. Yeah. That can be the market for potential for securitization of the future revenue flows. And I think SMI can be a potential as well, because we develop a credit asset based upon infrastructure projects. So we have a plenty variety of credit asset, in illiquid credit asset, direct finance to a variety sectors, in the form of long-term loan, long-term finance to infrastructure projects. But the thing is that our leverage is still very low at the moment. We are only debt to equity less than 1 time. So we need some sizable asset so that it's become more economical for us to come to the market to securitize our credit assets.
I do believe that what we are saying here is that securitization for infrastructure and projects has clearly a brilliant future. But if we want to make sure that it's a sustainable way to help to finance a part, you're right, it's not the only tool, a part. We need to make sure that the framework is extremely robust and consistent with what investors are expecting. So it will be slow. So it will be slow, but certain.
Is one of the benefits of this, developing this market and crowding in capital and all the rest of it, that over time, this is not just going to help get these projects built, but it's going to be more sort of economical for the entities that are doing it, because if you don't have to pay so much for your financing, if this market grows, if it's competitive, maybe you won't get those high double digits. Is that a potential one of the, am I being a little bit Pollyanna, that maybe this not just making people some money, but really having this greater public good?
Well, one of the reasons why multilateral banks are looking at instruments like securitization is because we do not have any certainty around future capital increases. Banks are battling to get future capital injections from their shareholders, so we have to look at how do we optimize our existing balance sheet. So this is one way to optimize or better manage your balance sheet and create space, because what you essentially do when you securitize, you no longer have to hold that much capital for a portion of your assets, which means you have more capital available to do more lending. So ultimately, it's all about creating that capital headroom and having more projects like the ones we've just seen, where building a big metro in Jakarta is something that's real and improves people's lives on a daily basis.
Okay. Well, gentlemen, I look forward. Maybe we'll do this again in 5 years, and we'll see how far you've all gotten. And oh well, anybody else want to cast a vote? Okay. Well, okay. Well, I want to thank my panel. I want to thank you as well for joining us today. I think they've given us a lot to think about, a field that does seem like it's full of promise and maybe even some profitability for the rest of us. Thank you so much, gentlemen.
Thank you.
Thanks very much.